Hello, everyone. In this weekend's feature from Growing Your Tree of Prosperity, we are going to talk a little bit about the topic. I'm going to talk about why today's guru is yesterday's Goondu. Okay? And this came from some other influencer who came out with this dichotomy, in the markets, right? When you make a decision to buy something, if it goes up, then you are the guru. If it goes down, then you are the Goondu. Okay? All right. And very clearly, the context is that the STI is on an all-time high. All right. So when I've created this slide on the 24th of July, STI is 4,262 points. Okay. Now, do note that high returns have not always been the norm. All right. With the results from January 2015 to January 2020, STI has only returned 5% annually. All right, 5% annually, but with a very low standard deviation of 12%, right? And that is when that period of time where if you are like me, you're an instructor and you focus on Singapore and you teach dividends investing, you will always be labeled the Goondu. All right. So that's the period of time I started providing investment courses in the year 2018. All right, at the end of 2018, that timeline. Okay, so there is a certain period of time in my professional life where we are always the losers, always the idiots. All right. But if you look at the results from 2020 to 2025, then you can see that the annual return has sort of doubled, right? The risk has obviously gone slightly higher, but not that much higher. Okay, but you notice that the Sharpe ratio has significantly gone up. It's almost doubled during that period of time. Okay, but of course, because 2020 also covers the pandemic event, the maximum drawdown is brutal, right? At about 31.66%. Okay, but nevertheless, if you have been investing right up till today, then you are the guru, right? You're the guru because your returns are good. Okay. All right. So this is the kind of context that we are living in. All right. Uh, and so I just wanted to come up with a set of slides to remind everybody that today's guru is yesterday's Goondu, right? So I was the village idiot in the training world because I was stubbornly building a Singapore-centric dividend portfolio, right? Um, I have never deviated from my original path, and the way I've invested has been consistent since the day I graduated from university. All right, always dividends and always Singapore stocks, right? But of course, I couldn't have predicted that Singapore would face the lowest tariffs after Liberation Day, and the flight of capital from the US bond market would reach the rest of the world. And now I think the question that everybody have in your mind, if you look at my video, is how high the STI can potentially reach. Okay, so I'm going to do a little bit of speculation here, and I'm going to show you my working. I don't think the difference between a guru and a Goondu is the results, right? I think you can have a very good process, and you will end up with horrible results, and you can have a non-existent process and you end up doing very well, right, in the markets. Financial markets are brutal that way, but I think someone who is a guru would show you the working. That means if I show you my answer in a maths problem, I'll show you how I think about it. And if you were to adopt the same working, you succeed, right? That's the closest thing to the guru you have. And that's actually kind of rare, right, in the investment world today. Okay, so I'm just going to show you my working. And on the 23rd of July, when the STI was at 4,223, the P ratio is 13.11. All right, so that's our starting point. So how much do we need the STI to be for the price to earnings ratio to reach about 14, which is considered fair value for most financial markets? Fair value is PE of 14. How much do we need? The STI needs to be 4,509. All right, so which means that we shouldn't be too excited if the SCI is going to be 4,005 by the end of the year. It just means that people have recognized Singapore and we are now at an average valuation, right, compared to the rest of the world. Right? So 4,005 is sort of a number which I can accept as a retail shareholder, right? And it shouldn't surprise me to wake up one day at 4,500. Now, on top of it, some of us might believe that Singapore has a stable government. It has a sort of I think current account surplus, right? With the United States, we import more from the US than the US imports from us. So we will not be punished as heavily as other countries that have been net exporters to the United States, right? On top of it, we have a stable government, right? On top of it, we are one of the hardest working people in the world, highest GDP per capita, right? So Singapore has value, right? As a country, our stock market has value with the amount of family offices coming in, right? And what MAS wants to do. Now, all this should be factored into a higher valuation. So if you believe in that, and you believe that Singapore can have a price earnings ratio of about 16, keeping earnings the same, then the STI needs to be at 5,153, right? Which isn't so different from JP Morgan's projection of 5,000, right? So that's actually very reasonable as well, all right? But how far can we go before things become a little bit too much, right? If the P ratio of a particular stock exchange goes up to 25, like US has been above 25 for a while, but I don't think Singapore can hit 25. But if Singapore ever reaches 25, our stock market would be too hot to handle, and we might be better off moving our funds into maybe Singapore government bonds. At that stage, the STI needs to be about $8,000 for 8,000 points for it to happen. All right, so there you go, right? So there are three layers that I think you should be mentally primed at. 4,005 for fair valuation of STI, in my view. 5,153 if you believe that the Singapore government deserves a premium for their efforts in stimulating the markets. And for the Singapore stock market to overheat, we need to be at about 8,000. Now, do note that on top of all these points, right? Earnings can actually drop. If earnings were to drop because of the Trump tariffs, then obviously the STI can fall. All right. Okay. And anyway, this slide just summarizes what I've said just now. All right. My action plan is 4,005. Don't do anything. All right. It is expected. Okay. Life goes on. Right. Keep collecting your dividends. Stay calm. Collect dividends. 5,153. We've made a significant amount of money. Anything beyond this, I might start to pay off my mortgage loans, right? Put off a certain amount to park it in the high yield savings account. And then when my fixed rate period ends for my mortgage, pay off a certain amount in a lump sum format. All right, so I might do that if it reaches 5,153. At 5,153, I think I would have done quite well for my margin account. So I will begin to stop leveraging my margin accounts. All right, so no more leverage. Okay, if the market continues to go up to 8,000, the markets will become very euphoric. There is no benefit in actually continuing to conduct my early retirement masterclass because the markets are too expensive. If the students were to invest in the STI at 8,000, they're potentially looking at a very large downside. All right. But of course, by then my portfolio will be huge. I wouldn't need to support myself with investment training. All right. So two things can possibly happen. I can stop conducting my early retirement masterclass, or I will find a new way to build up a portfolio in the cheaper market. So ERM might shift. For example, we might run ERM for Hong Kong blue chips instead of Singapore blue chips, right? Get cheaper markets in the rest of the world. We will do that. We will also become a lot more bond centric in our investment training. All right. So this is just a discussion on what I would do if the STI hits these particular points. It doesn't mean that I would actually do it because I guess right now the mindset of the investor is that very few people can even believe that we will touch 5,000 points. Only JP Morgan, I think, believes in that. And they're right. And I believe that they're right. Okay. All right. And of course, like I've said just now, earnings may drop instead. So instead of market prices going up, earnings can drop, and this can come from lower trade thanks to the tariffs. Now, this scenario will be disastrous as Main Street Singapore by then. If earnings were to drop, we would be facing a serious recession already. And in such a case, you would notice that the analysts would then begin to talk about, how far can the STI drop? Will it settle into a number that is very low? For me, I think it will drop to about 2005. All right, so this is the negative scenario. I consider this very low probability. This is a very low probability event, right? I'm actually more positive about the markets today. Okay, so but we should always be prepared for the worst, right? Yeah, and of course the gurus today will be back to becoming the Goondus of yesterday. Okay, at the end of the day, what am I trying to share with everybody is that equanimity is a virtue. When markets are doing well, we should be humble, right? Not too long ago, we were branded idiots, yeah, doctoral trainers were laughing at me. Yeah, and wow, those days are so long gone, right? We should remain humble, okay? But when the markets turn against us, we should be prepared to exploit this downturn. And hopefully along the way, dividends give us the resilience to invest. Wait for the next turnaround. All right. Uh, we've gone through so much together. We've suffered so much for the past 10 years or so, right? And we can continue to struggle. All right. So long as we continue to look for companies with high free cash flow, and the properties that we own continue to generate dividends for us. Okay, so if you like my material, subscribe to my channel. If you want to know my life story, Google ERM intro and take the first link. And I'll see you during my next preview for my early retirement masterclass. And that's all I have for you this weekend. Thank you very much.